All right, my beautiful people. I hope you're having a wonderful weekend. Today, I'm going to talk about how to turn a losing trade into a winning trade using options. So as you see, I got many titles for this: The Art of Options, Becoming a Finesse God, Working the Well. But I asked you guys for some recommendations, and I think I really like this one because we had a question on stream. Shout out Nazim. He gave this, and we're going to talk credit spreads as part of it, but overall the multiple strategies with options and how you could use options to get creative and manage and handle your position. So I'm going to use Robinhood to show you guys how to do it on Robinhood, as well as tastyworks too. But the best thing to take from this, and this is one thing I really want to highlight, it doesn't matter what brokerage you're on, okay? One may make it, oh, it's easier. Should I switch here? Should I do this? No. It's the Indian, not the arrow, my friends. It has not. If you don't understand what you're doing with these concepts or how to manage these positions, it doesn't matter what brokerage you're on. So I want to make sure we get that out of the way. But I hope you guys are ready for this. Like I said, we're going to talk credit spreads. We're going to talk rolling over. We're going to talk butterflies. And overall, I'm going to show you a few different plays, both that we've done, how to do it, and then some plays that I have now that we will execute on Monday, or again, that you'll see me handle over time. And the key to all of this is making sure you are factoring in timing and how important that is to when to act, especially if you're down on a trade or if you make an option trade, it goes against you, understanding the factors that you could use to your advantage. So before we get into it, drop your thumbs up on the video. Make sure you are subscribed, and make sure you subscribe to our live trading channel. It is the first link in the description, and it's also pinned in the comments. And we'll see you Monday in the watch list tomorrow. So the first thing I want to talk about, the 3 ways, is if you're down on a trade, and again, I'm referring to options here, so you can use some of these strategies if you are trading stocks, and how to use options to hedge is actually how options were initially intended to be used. And surprisingly, it'd be a lot simple, but here we're going to be referring to, let's say you're in an option. So let's say the option goes down in value on you. You buy an option and you're down a lot of money on it. And now this is the first key that you have to understand. It all depends how much you're down on, especially with any of these strategies using spreads, credit spreads, all of this. You have to ask yourself, how much are you really down and what's the dollar amount? Mainly if the options hold enough value, it will make sense, but sometimes it won't. And that's why I don't like trading smaller price companies. And then depending on how much you're down, if you do this when you're down already 90%, it's probably going to be too late. If anything, you could still do it, but the spread is only going to help you lower the cost basis if you're already down. So even before we talk about the butterfly aspect of it, simply what the spread is that you bought a contract, you're down on it, and now what you would do is you would sell premium instead. So let me show you a play that I have. Here's my Beyond Meat contract. I had this 185 for November, and I bought this months and months ago. And as you see here, I'm down $2,000 on it, or 86%. Now, the best part you've seen with this play is this one has time. And this is what I'm saying, understand the factors on it. And you might be like, well, you're down. Why does it matter if you have time? I've already made this $2,000 back. So by holding a contract with a lot of time, and at one point when Beyond Meat was a lot higher here, it was even in the money, I used that to create spreads both ahead of time and when the contract was down, because at one point, even then, because this is where you have to understand, if you bought a contract at too high of a price, it could still even get back to the money and you'll still be down. And that's what happened here, but it didn't change the fact that other positions were worth a lot of money. So you could even see here, I could sell these for 190, or another thing you could do, this is called a calendar spread. I'll call it a ghetto spread. I could even go out to February 20, let's say. Now this is a lot more risky because you see a 185 now. I could sell a 190 for 265, which I guess isn't too bad, but no, that's actually awful because I could sell that one right here on the same date for about like $100 less money. So again, this is on you to determine if it makes sense and if you're going to take this risk. But originally what I did instead is I would sell the short term. So even though when I was only down like maybe 20-30% and the stock was going up, I would just sell premiums on the options that were further out of the money or right below it and turn it into a spread to collect money. And now I would pretty much do that week after week after week. And I've done it already on plays to collect over $2,000 on it. So again, when you do a spread, if you're going to turn any spread or any play down into a spread, more often than not, it's going to require a lot of time, a lot of planning, and that usually will only lower your cost basis. So that may not be the most helpful thing to start out with, but you got to also understand the concept of what we're doing here is taking a single leg option and turning it into a multi-leg option and adding factors, whether it be more time, different strike prices, different dates, so on and so forth. So on the other end of things, let me show you a play that you guys saw us do, because this is even highlights just the opportunities you can make, where if you are proactive on this stuff and you're paying attention, you could now even make sure once you're up on a play, you turn it into a win-win. And this is something I talk about a lot, and I talked about this too in the advanced Robinhood video for selling spreads. But take a look at this AMD right here. We bought this for $19. It's trading at 47 bucks. So this was a 26 put that expires in September. So now instead though, after we were up on it, we bought it for 16. What I decided to do here is I went to this 24 put. So we did that about two weeks ago, or a week and a half ago. And what happened is I got $34 in credit, and it's a 24 put. Remember, we own the 26. So I noticed we were up on the 26 a lot, and then these ones had a high value. And this is what I'm trying to highlight, both make a win-win, but now you guys could see how option pricing is so all over the place. You could use, if you're paying real close attention, whether you're up or down on a contract, there's going to be dislocations in price, especially even as the stock moves. So again, that $26 put, we're up on that one, but then I'm also up on this. So what did I do is I sold this contract for 34 bucks, but now it's only worth 19. So we made actually 40% on that so far. I could even now cut this play out, and it pretty much made the other trade free, or we could hold this, and then, even if AMD plummeted, I own the 26, we sold the 24, I would still walk away with a guaranteed $200 or more than 1,000% on the first trade. So this is one way you could see, again, how to use these strategies as well. But now the big one is a butterfly. And now a butterfly can help you walk away with profit or turn it into a higher probability. So now let's say on this play, I'm down on this 185. And now if you don't know what a butterfly is, it's when you buy one contract, sell two. So I'm doing this one actually reversed. You would sell two and then buy one more here. So again, let's switch this to two contracts. And as you see here, so if I bought this contract, sold two of these, and then I held this one, it creates a whole different play. And the key with the butterfly, if you see now, I would be buying one of these 165s, selling the two of the 175s, and then I would still be holding the 185. And it allows me to get closer to the money and get a higher probability. And pretty much on a butterfly, you profit everywhere up until the middle strike. So if it goes above your middle strike, that's when you start to lose. If it stays and expires here, if the stock price at 175, we collect the premium and we would get $1,000 of value here too. So usually this is probably one of the best things you could do, and it all depends on the price of the contract, especially if you could sell them for more money. And with this, what I mean by turning a losing play now, again, that Beyond contract was expensive, but if you could go here now, pretty much we could sell two of these for $550, and then you could buy one of these. I got to reverse that. Well, this should be buy one and sell two, but then you could buy one of these for $500. So literally, you could walk away with $50 more and then get now a strike $10 closer and have a whole different play. But now you guys got the butterfly down, and that one's part of it. But again, the butterfly is really the best to take any random play. And just like that AMD play earlier, it's kind of a mix of that, especially if you notice the premiums are high, or if you're down but not too much. The key would be, the most ideal is where you're down not 80%, but let's say you're down 50%. If you're only down 50%, you could probably do a play where you walk away with a few $100s and turn it into a butterfly. And again, the whole idea would be get closer to the money and increase the probability on that play, even though butterflies are a little harder to hit. So that's number one. Now, this next part, this is very important. This is the question we have, is rolling over a credit or debit spread. So you have to understand time is on your side when you are selling premium. So it's better to roll over a credit spread rather than a debit spread. When you are doing a debit spread, really, I would just let it expire. Again, you can roll over, but what I mean by that is if you did a debit spread and you're down on it and you want to roll over, it wouldn't make sense to just buy the same one when you could probably get a better contract if you're already down on that first one. But a credit spread is differently. And to answer, a rollover, if you don't know what that is when now you're in a position, it's coming to expiration or it's at expiration, or you just want to get out of the trade on that trade and then roll it over to something else. So let me show you how it looks here on Tasty. Let me find a spread. Here's the Qualcomm. Let's say we wanted to roll it over. You would click both of these on Tasty. You just click roll positions, and look what it's doing now. So here's the October we have, and it pushes it over to 1 month, but it's saying now we would sell to close these and then buy to close these, because again, this was a debit spread, not a credit spread. But the whole concept of a rollover, in one trade, it would close out these, and then go to the same exact strike price on the next day. And that way, I'm not on October anymore, but I get the same time with I'm rolling over the time. And as you see here, there's a few factors. It's telling you your max P&L. It's saying I would have a $45 debit. And if you go back here, net debit is going to be $15. So it's taking $15 from me. That's the net total debit. So even though it's saying a $45 debit, that's after closing out of the other plays and doing all that. So again, you would realize $88 a loss because I'm down on the first position. So it closes out of these. You take the loss because you spent a different amount here. Then you reopen and you spend a $15 extra. But now I get the same exact play, same risk reward, but now coming into November. So that is rolling over, but this is very important, especially if you're doing a credit spread. So I'll use that example. We talked about it a few times. I know this was brought up on stream, but here's one thing too to note. You just saw me do it. Tastyworks makes it look easy. I just press roll over. You do not need a special platform or anything to do this. You just have to understand what you're doing with it and understand the whole concept here, because you could do the same exact thing on Robinhood. Let's take this Tesla spread, go to view all options, and wait, what do we own? We own the 185, 180 put, and this is a debit spread. But what I would do here now, let's go to the puts. There's our 185, so we need to sell that one because, again, we have +1. We would be closing this position, and then we're -1 on here, so we would need to buy that one back, close it there. So then this would be closing the trade. This is just simply closing that spread. And, again, for those of you on Robinhood, if you ever do a spread that's not like, sometimes if you buy them at the same time, Robinhood will group it like you earlier saw. But if you do a spread and it's ungrouped and you want to close out, or it's saying your buying power this and that, you go to view all options and you would do it like this. Now let's say again we want to roll over. The whole idea is close out of the August, be in the same position, and give us more time. So then now we go to, let's say, 1 week ahead. Remember, we got the 185. That's the one we're selling. So we'd want to buy one of those. And then we'd want to sell the 180, and then boom, you press continue. And as you see here, your total, it's giving you the difference, but it said earlier, total cost would probably be 21 cents. You pay a little bit extra, then you do it. But this is a 4-trade option right here. What's going to do? Close out this and reopen. That's rolling over. So again, that's a debit spread, but this is what you need to understand. You just got to understand what the hell you're doing, and don't trip when you're selling premium. Understand the odds and the max risk. So here's that example. This is the one that was brought up on stream. It was like on Boeing. They were tripping out saying they were down on this credit spread. They didn't know what to do. And again, if you don't know what a credit spread is, and this is what happens usually, this is only necessary if you try to sell premium on short term. So there's a few factors you have to take note of here. Be very careful selling short-term premium. Anytime I've ever really lost on premium selling is when I did short-term premium, or it made my life a living hell because I literally had to keep rolling over. But again, that is the strategy to turn a losing spread into a winner, because time is on your side. That's why I say it's better to just sell a lot of time than anything. That is the first part you need to be aware of, but then also the max risk. A lot of people will trip out, and sometimes if you sell a spread, so again, a credit spread could be like this. You would be, instead of buying this contract, you would sell the 360 and then buy the 365. So you would get a credit of 184. You'd sell this for 500, buy this for 340. You keep the difference in cash because you collected more on this. So you get credited money, and then your risk is on the back end. If it goes below 360, you make $185. Your gain is capped. But if it goes up now, that's where you lose. You take the risk on the back end because you got paid up front. But this is what you guys need to understand when you're selling premium. Your max loss is $500. That's it. And then if you collected 184, theoretically, your max loss is really just $500 minus 184. So roughly like 350, 320. So that's the problem, is that some of you guys will trip out. Even if this BA, like again, last week, Boeing started shooting up and you're like, oh my gosh, it says I'm down $700, $800. No, you're not. Because even though that's what the price is quoting, if it's still out of the money, and sure, there's assignment risk, but you have to understand, unless it's close to expiration, you're not going to get assigned. Nobody would do that. It doesn't make logical, rational sense. But the max you ever could lose on this trade is that $500 difference. So you have to chill out. And that's why usually by letting it go more and more time, the better. But now let's say it goes in the money. So let's say the stock right now is trading at 365. you're down that amount of money now, and you're like, well, what do I do if after it expires today, you have to eat the loss and you lose? Not necessarily, you roll it over. So instead now what you would do is you would buy these back and really just go to the next week, and then, or you could even go 2 weeks and do the same thing. You would sell this one and then buy back this one. So it'd be the same thing. You'd have to close this trade, take the loss. So again, if it was at 365, you would be down $300. So you would take a realized loss of $300, but then you would open up this trade right away again. You would sell it for 680, buy this for 520. You would collect that another $184 again. So you would take the loss, but now if it comes back down, the minute it drops out, you'll make that money back. But again, you're like, well, I just lost $300. So usually what you could do is you could add extra time to it to roll over and get a better play, but just be cautious of where you're at. But that is the strategy of how to do it. A lot of people, if you ever sell a credit spread and you're in the money, I usually myself, I just keep rolling it over. I did that, but then that's the risk, is that if you keep having to roll it over every time you're taking the realized loss and you're usually spending money or collecting less, you have to ask yourself, is it worth it? So if you guys remember, I did that with the Amazon, and I did it for about a month. I rolled over every single week for about a month, maybe a month and a half, and the stock was $150 in the money. And eventually it came down and I made all my money back, and I think I lost like $300 versus losing, I think, $1,500 or $2,000. So keep that in mind, but that is rolling over, and that is very, very important. If you guys do have questions on it, let me know, but I think it all really does come down to understand what you're doing and understand how the odds are going to be in your favor, especially if you're only doing credit spreads. Like we said, debit spreads, whole different story. But there's that. And then lastly, control thy position size, my friends. Average down to a more high quality option. And what I mean by all of this is, if you want to turn losers into the winners, I lose a lot, and it doesn't really matter to me because a lot of them are smaller plays. And then that's what you got to realize. If you are able to control it from the get-go. So even if you're selling a spread, here's your problem. Some of you are selling spreads with $1,000 max risks. It makes sense why you're freaking out, because you could lose $1,000 when you could do spreads for $500, or you could even sell these right here and do them for $250. You could do credit spreads for a lot smaller. Most people fail at trading because they're just starting out and they trade way bigger position size than they have the experience to handle, and they blow up their account before ever learning anything that would advance them to the next level. If you guys want to play with these strategies, you want to do it, sell a lot of time and sell tighter spreads so that your max risk isn't there. And if you still are going to sell the weeklies, just tighten it up. Again, make it a $2.50 max loss. You may only make, you know what, this one you buy at 6, sell at 5.10. You bought at 15, maybe you got filled at 14.50. You'd make like $60, but your max risk is only $250. If you don't understand what rolling over is, if you don't have enough capital to roll over for multiple weeks, you don't know any of these other advanced option trading strategies, give your ass time to learn that. You can't take the $1,000 risk. You don't know enough, or you're just setting yourself up in a position where it's just going to make life in trading a lot harder when you could do things a lot easier. So please just control your position side, because again, the whole point is too, now if you buy an option and you're down on it, you don't buy the same option again. So again, in this case, so take a look at the Beyond. This one's still expensive because it has a lot of time, but even then, the best strategy wouldn't be, okay, I want to buy it again. Even if I wanted to spend more money, I'm going to get the same contract. It would make more sense to get closer to the money and improve your odds. Again, going back to that one play here with AMD, you'll notice the one closer to the money actually went up in value, but this one is still cheaper than when we sold it. That's why we're winning on both. So you have to keep that in mind if you guys want to do that. And even another idea, if you, let's say you did, again, here to give you guys information, not, just trade small, blah, blah, blah. I get it. If you already did make a big trade and you're wondering how to get out of it or make it a little bit better, you still use a small amount, but do it better now. So if you've already put in a big amount and you're down, don't try to keep buying the same contract. Either go to a shorter date so that there's more theta premium, and if you could try to get a quicker flip, or you just keep it on the same contract, but try to spend a small amount of contracts or small amount of money to get a closer to the money contract, because even if that hits, these ones could probably gain up a little bit of value, but if you get the right contract at the right price, it could help increase the value. So that's pretty much it, you guys. It's pretty much talking more in the spreads and the rolling over. Hopefully this makes sense. If not, you guys could go see some of the other videos we've done, or just come in live and you'll see this more. But let me know what questions you have. Make sure you guys are subscribed, and make sure I see you in the morning on Monday and on the watch list tomorrow. Let's go!